You spot a perfect reversal pattern on your chart. You execute the trade completely confident the trend is about to turn. But instead, the market immediately plummets, shatters support, and triggers your stop loss. This scenario is common because the market preys on traders who treat candlestick shapes as isolated, magical triggers that guarantee a price turn. Relying on a pattern in a vacuum ignores the actual mechanics driving the price. A visual shape alone provides zero insight into the larger data happening between buyers and sellers. Effective trading on the FXNX platform requires analyzing the why and where behind a shape through a strict 3-layer filtration system. Success depends on aggressively using these filters to disqualify weak setups long before risking a single dollar of capital. Filter 1 is context. The physical location of a pattern on your chart dictates its validity. Markets behave like battlefields, where the most significant conflicts happen at specific geographical choke points. This chart demonstrates the primary choke point, support and resistance zones. When price repeatedly bounces off a historical floor, that level becomes a vital boundary. Adding a dynamic moving average that intersects that support creates a targeted crosshair, offering a mathematically higher probability of success. Once you identify a high-probability choke point, you must read the psychological footprint left by the candlestick itself. This illustrates the decisive shift of an engulfing pattern. One side completely consumes the previous session's body, transferring control. Conversely, the hammer represents violent rejection. Its elongated lower wick proves sellers tried to force a new low, but failed before the session closed. We also look for the stalling momentum of morning and evening stars, or the pure indecision of doji candles appearing at market extremes. These shapes represent the visual exhaust fumes of market exhaustion, indicating where the current trend has worn itself out. Identifying an engulfing candle or a hammer diagnoses a temporary psychological vulnerability, providing a starting point rather than an immediate green light to execute. The final requirement for entry is confluence, independent external evidence that validates your reversal theory. Momentum indicators provide this secondary proof. You must cross-reference the pattern with tools like the RSI to identify divergence, or look for a massive spike in trading volume during the reversal. The most crucial validation step is waiting for the subsequent independent candle to close. You need to see the price lock its final close position clearly above the high of your initial reversal pattern. Demanding this final layer of confluence eliminates the majority of low-probability fakeouts, protecting your capital from premature entries. When a setup survives all 3 filters, the analysis is complete. Execution now depends entirely on strict mathematical risk management. The red boundary line dictates risk. Placing the stop loss below the extreme wick marks where our thesis is wrong. We set take-profit targets at previous structural zones, ensuring our reward is mathematically twice the size of our risk. This disciplined approach separates the professional from the amateur. While others react chaotically to every shape they see, the probability trader lets the filtration framework dictate the terms of engagement. Mastering reversals requires the patience to wait for location, psychology, and mathematical confluence to align perfectly before striking. Put this system into practice today. Use the advanced charting tools and demo accounts on FXNX to start disqualifying the noise and trading only the highest probability.